You did the hard part. You found the house, you put in the offer, you got the counter offer, you're approved. Now you're at the bank sitting across from your mortgage expert. You're almost done. You're about ready to sign. And they say to you, would you like to add mortgage insurance to that? It helps protect your home. Sounds easy, doesn't it? It's one box left to tick and you're done. But let's take a closer look at that. Welcome back, everyone. I'm Marco with Making Better Sense. I'm a licensed agent here in the province of Ontario. And as you guys can tell, I'm enthusiastic about personal finances. I want to be able to help all Canadians learn about financial literacy so that we can all grow together. In under 10 minutes, we're going to talk about the 5 most important factors you want to consider before signing for that mortgage insurance versus term insurance. We're going to talk about who gets paid. We're going to talk about portability, who controls the underwriting process, how coverage changes, and who controls the money. So stay tuned. Quick definition for underwriting is that it is the safety check insurance companies do before they promise the big payout. If you think of an amusement park, they always have those signs that you have to be X tall to ride. You can't ride if you have a heart condition. You can't ride if you have a pacemaker. It's basically them wanting to make sure that you're a safe bet before they give you the insurance. Now let's hold on to that because that's going to be really important in a few minutes. At closing, mortgage insurance is usually creditor insurance that's attached to the mortgage of that particular lender. If you were to pass away, the benefits are paid to the lender, to the bank, to clear your mortgage. And what that means is that that mortgage insurance, the bank is the beneficiary. They get the money. Your family does not control those funds. In terms of portability, it's specific to that vendor. So if you decide to renew your mortgage somewhere else, then you're going to need to requalify for that mortgage insurance. In terms of coverage, your coverage declines as you pay off your mortgage, but your premiums stay the same no matter what. And that's something that's a little bit funny. Now, something to note is that the underwriting process, as we mentioned earlier, the underwriting process is what's called a post-claim underwriting, which means that they will underwrite you and see if you're fit to be insured when you put the claim in, not before. So fewer questions now, but a lot more questions down the road. The paperwork seems really easy and really standard at closing, but that certificate is where the real rules live. In contrast, personally owned term life insurance is exactly that, personally owned. You own it, which means that you get to choose the beneficiary. You can leave it to your spouse, your partner, your children, and they will decide what to do with the benefits. So they can choose to clear out your mortgage, or they can keep it for replacing your income when you pass away, or perhaps they need it for childcare needs. Maybe they don't need the money and they're just going to take that benefit and invest it for their future. Now, a couple of key things to note about term insurance is that it's a level benefit and level premium, which means that if you take out a $500,000 policy, inside of that 10, 20, or 30-year term, that will never change. You will always receive that $500,000. So as your mortgage decreases, your benefit remains the same. And locking it into that term will also lock in your premium for the life of that term. Underwriting is different as well. When you go for term insurance, the underwriting process is done at the time of application. So there's more questions about health and lifestyle up front in order to get you approved, and not as many when you're ready to claim for that. So it's a much cleaner claim process. Now, in terms of portability, because you own this insurance, it will follow you around to any lender or any bank you go to. So if you choose to renew this somewhere else, you don't have to be reapproved for this insurance. In a previous episode, I mentioned that term insurance is temporary insurance, and I'm going to put a link to it up here. But that's the point. This is a great example. You get to choose the term and match that up with your temporary need. So in the example of a mortgage, you can pick a 30-year term with a 30-year mortgage, and then you simply just let it roll off when that temporary need ends. And that's the difference between protecting a loan versus protecting a life. Let's take a look at those 5 factors again. When we look at who's protected, with mortgage insurance, the lender is the one that's protected. Whereas with term insurance, your family and loved ones are protected if you were to pass away. As well with portability, when it comes to mortgage insurance, there is no portability. It's specific to that lender, whereas term insurance will follow you around regardless of what lender you're using. Underwriting is another key difference because the mortgage insurance has post-claim underwriting, which means the medical questions are going to happen after a claim's been put through, whereas with term insurance, it's done upfront at the time of application. So it's much smoother when it comes time to claim. Coverage as well is a big difference because with mortgage insurance, it's decreasing coverage. You pay your mortgage off and you need less insurance, but your premium remains the same. Whereas with term insurance, your benefit remains the same and it locks your premium for that 10, 20, or 30 years. Now, the biggest thing and the most human aspect of it is who controls the money, who controls the check. And for mortgage insurance, the lender uses it to pay off your mortgage, full stop. You don't get a choice in the matter. With term insurance, it's your family that gets to decide how they want to move forward with that money. If you value flexibility, you're going to like the way term insurance works when life zigzags. Let's take a look at an example of 2 couples, same mortgage. One couple opts for the bank add-on. So after years of paying down the mortgage, the coverage decreases, but their premium stayed the same. One of them passes away and the bank gets paid the insurance money. That's it. The other couple opted for term life insurance. After years of paying down the mortgage decreases. One of them passes away. The surviving spouse received the full benefits of that term insurance, and they got to decide how to use that money. Now, let's think about this. Which outcome gives your family the best options during one of their toughest times? Is there a situation where the lender option is a better fit? In all fairness, yes. The lender option is a great temporary stopgap. So if you can't get term insurance right away and you need that basic coverage immediately, then this is great. You can always reshop it later. Just know what the trade-offs are. Either way, it's just really important to know who's being protected, when the underwriting happens, and who controls the money. Okay, full disclosure. As I say every week, I'm a licensed agent in the province of Ontario. So insurance is my jam. I'm passionate about insurance just the same way I'm passionate about finances and personal finances, because it's important. It's all wrapped together. So if you want protection that follows you around and puts your family first, then personally owned term life insurance is usually a clear path for most Canadians. That's it for me this week. If you think someone needs to hear this message, send them this video. You guys know what to do. But what was your experience when you went to the bank? Did you opt for that mortgage insurance or did you go for term insurance? Did you even know that term insurance is an option instead of mortgage insurance? Let me know in the comments. In the meantime, let's make better sense together. All right, there's gonna be some videos somewhere here. One of them is gonna be FHSA versus TFSA versus RRSP. And the other one is going to be segregated funds versus mutual funds.